Bringing you the latest in tax credit news, insight, and analysis, this is Tax Credit Tuesday. Sitting in today for Michael Novogradac, here's your host, Tony Grappone.
Hello, I'm Tony Grappone, and this is Tax Credit Tuesday. This is the July 1st, 2025 podcast, and this is the latest installment of our monthly Renewable Energy Tax Credit Finance series. I'm usually the guest on this series, but today I'm filling in as host for Michael Novogradac. And I'm here today with my partner and guest, Josh Morris. Today's episode is all about the Begin Construction Test, an essential concept for taxpayers looking to qualify for tax credits under Sections 45, 48, 45Y, 48E of the Internal Revenue Code. We'll break down what it means to begin construction, why it matters, and how to meet the IRS requirements to qualify for these tax credits. We have a lot to cover today, so if you're ready, let's get started. Josh, all right, welcome back to Tax Credit Tuesday. It's been a long time since you've been on here, but as most people know, you and I work really closely together. I don't think there's any partner at the firm that I've worked with more over the years than you. And so recently, when I was asked to host this week's podcast, they asked me to suggest a guest, and it was super easy for me to say, let's get Josh in here. Him and I work together a ton. This would be just a blast. How you doing, buddy?
Doing good, Tony. Glad you thought of me. You know, I'm an avid listener to the Renewable Finance series. I check in on all of those episodes, and it's been a dream of mine, to have this happen where we could be, kind of in the trenches together and talking about the tax issues that you and I face every day together. Like you said,
Yeah.
We're always on the phone. We're always talking about the things that are happening. And so why not let our clients and our listeners hear us banter about nothing better than begun construction. So this is a real treat. I'm happy to join you here.
Awesome. And that's what this is. I mean, I spend a lot of time on the phone just debating different tax scenarios, issues that our clients are dealing with. And so this podcast is actually almost like an opportunity for listeners to tune into a conversation the type of conversation that we have on a regular basis. So it's kind of neat.
Which could be kind of scary too, right? If people are always listening.
Yeah.
But yeah, they're gonna get a little piece of that.
Yeah, indeed. So hopefully people love. So I'm excited. All right. So before we get into the weeds of begin construction, do me a favor and just kind of remind clients what are some of the more relevant services that you're spending most of your time on these days.
Sure. Yeah, we provide a lot of different services. My team and I, we really do specialize in renewable energy, and we provide all of the different type of accountant style deliverables. We provide financial modeling services. We provide cost segregation studies. We help folks with compliance matters, compliance issues that need to be sorted out from a tax standpoint to close the deal. That might include prevailing wage and apprenticeship, AUPs, domestic content AUPs. For those that don't know, AUP stands for Agreed Upon Procedure engagement, and in those engagements, we're able to really dig into the compliance issues and help folks do a fact-finding mission there. And then we also help our clients once they've closed the deal, carry it through the operational period with compliance matters like GAAP, financial statement audits, tax return preparation, and any other tax issues that kind of pop up as you're operating that asset and making sure you stay within the rules related to these tax credits. We do a lot of partnership work, right? And these partnerships have a lot of tax issues, and if there's some type of quantitative analysis that comes with that, my team and I we're excited to be involved there.
Indeed. Excellent. All right. Thank you for that. Okay. So let's get into it here. Let's start talking about begun construction. So first off, Josh, why is begun construction so important right now?
Yeah, great question. I mean, look, it's really one of the most important issues that the whole renewable energy industry is currently facing. There are a number of different paths that your project can be on from an economic standpoint, depending on when it begins construction. We all know what's going on around us with the political issues that the industry is facing, and this is all in flux yet, so we don't know what the rules are going to be. But one thing we know for certain is that when you begin construction, it's really going to matter. It's gonna matter on a lot of different issues that will impact the viability of a project. How much is that project worth? What tax credits can you generate based on when you began construction? So, knowing how to satisfy these rules is crucial. If you began construction before a certain date, the amount of the tax credit available is going to be determined. What tax guidance you're operating under will be relevant. Are you under the old 48, 45 rules, or are you under the new tax neutral rules for 48 cap E, 45 cap Y? FIOC, that's a new issue that has come up with the proposed legislation. Whether or not it's applicable for your project might depend on when you began construction. Certain other tax issues like prevailing wage and apprenticeship requirements, domestic content rules. For domestic content, there's escalations of certain key percentages for domestically manufactured products. When you begin construction matters. So I guess what I'm trying to say here is that a lot hinges on when your project truly began construction.
Definitely. Yep. Thanks for summarizing that. So, yeah, the begun construction rules, a lot of us in the industry have been familiar with these for years, right? There's, under the if we go way back in time to the 1603 days, developers needed to commence construction in order to safe harbor eligibility for the 1603 grant. Then we saw the begin construction criteria come up again when the tax credit percentage was starting to sunset from 30% down to 26% and so on. So we've seen the begin construction stuff come into play at various different sort of points in time. Then when the IRA got passed, people started to kind of forget about begun construction to a certain degree, right? I mean, they kind of felt like they had this really long runway. I mean, last year, we saw some developers try to safe harbor to preserve eligibility under old sections 45 and 48. But aside from like maybe a smaller segment of the industry, I think a lot of people, once the IRA got passed, they thought, okay, these begun construction rules aren't quite as critical as they used to be. And so this is kind of a good refresher. These days, like right now, I mean, begun construction is it's probably the hottest topic in the industry for the reasons that you noted, whether or not you're trying to safe harbor to preserve eligibility under those old section 45, 48 rules, or maybe you're trying to safe harbor something for solar and wind under the tech neutral credit provisions. Maybe you're trying to demonstrate begun construction prior to when the FIOC rules kick in, right? So there could be several different instances where it's really important to show when you commence construction. All right, awesome. So with that said, how do taxpayers prove that they began construction?
Right. And so to your point, this is not a new concept, right? These rules have been established for quite a while. And there's a lot of guidance on the subject matter. In fact, several IRS notices have been issued. I think the first one was back in 2013. When we were thinking about the phase down of the ITC and PTC, this relevant guidance came out. Since then, it seems like almost every year, every other year, there's some sort of a refresh or some sort of an enhancement to further clarify what these rules are. And so we could spend a lot of time doing a history lesson going over every IRS notice, but I think you and I want to spare our listeners exactly of that and try to kind of put it into a simple form here. And so there are two relevant tests for meeting begun construction. You have the physical work test.
Yeah.
And
Josh, hold on one second. All right. So I liked where you were going there. So you talked about all
Yep.
the various guidance that's come out from the IRS going back to as far as say 2013, right? But right now, we've got legislation that's kind of going through Congress,
Mhm.
which we believe is going to turn into some sort of new tax law that's about to get passed in the real near future here, right? And
Right.
one thing that a lot of clients were asking is, as part of this recent tax law package, have they already mentioned changing the rules for beginning construction? I haven't seen anything yet in the House bill language or the Senate bill language that talks about changing the rules for showing how you began construction. I think that's your understanding as well, right?
That's true. Yeah, I
Yeah,
haven't heard
right,
of any. I haven't heard of any new rules around establishing new guidance yet.
right, right. So at the moment, we're still talking about if you've been in the industry for a while and you're kind of familiar with the rules for beginning construction, we're kind of talking about those legacy rules, right? That people
That's
have been
right.
used to for a while. Okay, great. Sorry to interject. I just want to kind of point that out before you got deep into the test for
Yeah,
begin construction.
yeah, no worries. And I mean, you wonder to yourself, could there be another refresh? Because it is so important. Maybe, I don't know.
Right.
Where we're at right now, as the Senate is intensely debating, it seems like there wouldn't be time to issue a refresher. It's these are the rules, and I expect that we would, be operating under that legacy guidance with maybe something that comes out to just refresh and say, hey, by the way, we're still talking about these notices, these rules, right?
Right, right. Yeah, good point. Yeah, but as far as we know, based on where we're at right now in the process, we're still dealing with kind of the legacy rules that have been in place for a while. Okay, great. Yep.
That's right.
All right.
That's right.
All right, break it down for us. What are the methods available to taxpayers?
Right. And so there's these two relevant tests here that this legacy guidance has spoken about. Number one being the physical work test, and then number two being the 5% safe harbor test. The physical work test is qualitative. It's a qualitative analysis, while the 5% safe harbor test is more quantitative. Um, that physical work test, when we're talking about it being qualitative, it's really all about it's satisfied when a project begins physical work of a significant nature. The focus is on the nature of the work and not necessarily the amount or the cost of the work incurred. Now, on the other hand, the 5% safe harbor test is quantitative, less subjective. That 5% test is met when a taxpayer incurs 5% or more of the total cost of the energy property. And the focus here is on how much you spent and incurred versus the nature of the cost. To a certain extent, the nature of the costs do matter, but this test is more objective as compared to that physical work test.
Great. All right. So you got two methods there. You got physical work of a significant nature. You got the five, or second, you got the 5% test. Uh, do taxpayers need to meet both, or is it like you pick one or
Mm.
the other, or do you need to meet both?
Yeah, good question. I get that a lot. You don't have to meet both. You can meet one or the other.
Yep.
Kind of pick and choose. It's helpful if you meet both. You might be able to avert risk if you're not feeling good about one or the other. But yeah, you only need to meet one of these tests to begin construction.
Right, right. Every once in a while, I'll meet a client that goes belts and suspenders, and they try to meet both. But most clients, it's enough to meet one of the tests, so they kind of just pick one and go with it. All right. So now we're going to get into a little bit of a role play scenario, right? I'm going to play the role of one of Josh's new clients. All right. So we just got engaged as clients in a client service provider relationship, and I am going to pitch Josh some scenarios where I'm hoping to meet the start of construction criteria. I'm a developer, okay? And as a developer, one thing that's super important to me is cash management. I want to manage my cash as efficiently as possible. So I've kind of looked at the physical work test and the 5% test, and I'm feeling like from a cash management standpoint, the physical work test is more appealing to me because it doesn't require me to spend a minimum amount of money or incur a minimum amount of costs, right? It's about the nature of the work. So I'm thinking, all right, this might be more physical work, might be more cash efficient for me. So we got on the call and I'm telling you that here's what I've done so far. I've got a renewable energy facility. I've done some permitting work. I have done some design and engineering. And I'm hoping that the design engineering, the permitting work I've done is enough to show that I've started construction. And I'm curious to get your thoughts on what I've done so far.
Okay. Okay, so you've incurred some preliminary activities from what I can tell. On the surface, I'm feeling like that's not enough. That's not going to be enough for the physical work test. Number one, the guidance does very clearly say that preliminary activities generally would not qualify for physical work of a significant nature. Now, what does that mean exactly? What are preliminary activities? That would be planning, designing, securing financing, obtaining permits, conducting different studies, site clearing, um, excavation that only changes land contour. These things are generally not considered physical work. And I think those items that you described there wouldn't generally fall into the physical work of a significant nature. We need to do more. We're going to need to do a little bit more than just that. Another thing I want to point out would be that you also can't count on incurring non-energy property type activities. Okay, that would include working on transmission property, roads primary for access, fencing. You can't just build a fence around the perimeter of the site and feel good that that is physical work. That's a non ITC eligible cost. Also working on buildings, right? That's non ITC eligible property. We have a lot of clients that are putting solar on rooftops, right? I'm getting a lot of calls from clients saying, well, look, I'm going to put the PV on the roof in 2027, 2028. We've got a lot of costs we're incurring related to the building. Uh, that surely that's physical work, right? And so it would not be. It wouldn't count. It has to be physical work related to energy property.
Okay. That's very helpful to know. I'm a little disappointed because that's what I've done so far. But what can I do? What types of preliminary, or not preliminary activities, but what types of on-site work can I do that would qualify for physical work of a significant nature?
Sure. Yeah. So the on-site physical work would be activities, as I mentioned, related to the energy property that are not preliminary in nature. That would include excavation for foundations, setting anchor bolts, pouring concrete pads, for wind facilities, for solar facilities, installing racks or structures for the solar panels. Thinking geothermal if you install piping or generators for geothermal property. Um, On-site roads that are integral to the operation and maintenance of the facility might count also. But the key here is that yeah, it's on-site physical work that is related to the energy property.
Okay, that's super helpful as well. All right, now let's say I'm not quite ready to do those types of on-site activities. Is there any opportunity for me to do some physical work of a significant nature off-site?
Mm. Yeah, that's a great question, right? You might not be ready to do this physical work on site yet. But the good news is there is a path. There is a path to performing physical work on items that are not on site. Those off-site activities are a little bit more challenging, but there certainly is a path. The guidance talks about manufacturing specialized components that are project specific if done under a binding written contract. The key here is that the manufacturing is of a component that is not typically held in inventory. It can't be that you just call up your module supplier and say, hey, let's start building my panels. Let's start manufacturing those. I need a bunch of them. And then just counting that. Typically, these modules are held in inventory and may not be specific to the project. And so, yeah, if you incur off-site physical work with a manufacturer that's specific to your project, then that can count too.
Okay, great. All right, so modules are out, sounds like, or anything that's really could be considered held in inventory is out. If I'm a solar developer, any types of examples of components that that typically work under the physical work test on an off-site basis?
I feel like transformers. Those are the components that most of my clients utilize for their strategy. In most instances, you're going to have transformers made specific to that facility, right? I've heard of customized inverters. I think that's a little bit tougher. I think most inverters are, kind of coming off the line and not specific to a project. Racking. I've heard of some pretty specialized racking components. And so yeah, those are areas. Definitely transformers. I feel like every time I'm talking about physical work with a client, they're typically using that strategy or had an attorney involved writing a opinion on that matter.
Same. Yep, totally agree. Okay, fantastic. Now, okay, so in terms of the physical work test, right? It's all about the nature of the work. It's subjective, right? A lot of clients they want to figure out, well, is there a minimum amount? They want to try to back into some kind of safe harbor element here. And they see the 5% test and they know that provides a bit of a quantitative analysis. So when clients are looking at the physical work test, they want to try to incorporate some quantitative aspect to the physical work test as well. Anything out there? Heard anything? Words of wisdom there on clients trying to build in some kind of objective analysis on the physical work tests? There's nothing in the guidance, right? I mean,
Nothing
it's
in the
all
guidance, right?
yeah, it's
Yeah,
all
this
it's
is tricky. When it comes up, when my clients ask me about this, I, s- I see why they're asking, because especially for me, I'm an accountant. I think of numbers, and I'm like, well, if I spend a certain amount, then that makes it feel more significant, right? That's the key word of this
yeah.
piece of guidance. It's physical work of a significant nature. So, what does significant actually mean? And to your point, there's nothing in the guidance that puts any um, you know, quantification to it. And so I'm always careful when talking to my clients about that to not try to put a number to it because that would be arbitrary. That would
Right.
be an arbitrary thing to do. But naturally, you want to ask yourself, did I spend enough? Is this work significant enough? And if you're incurring physical work on something that's very minor, from a dollar standpoint, you might really feel concerned if it's enough, right? And
Mhm.
so I guess the advice that I would give is to really think about the nature of the work here and not necessarily the cost or the amount that you're spending. Certainly, there's some subjectivity to that. If you're only spending $1,000 on a project that's worth $200 million, that doesn't feel significant, right? But again, I wouldn't attach any dollar figures to it since the guidance hasn't done so itself, but really focus on the nature of the work.
Yep. Great. Yep. Perfect. Yeah. So there's nothing in the guidance that will help get you to some sort of quantitative calculation on the physical work test. That being said, if you've got tax counsel, you can sometimes work with your tax attorneys or maybe some other um, financing parties to your transaction. You never know. They might have their own sort of comfort levels with quantitative analysis for the physical work test, but maybe work with those directly with your tax attorneys and or your financing parties. They might have something that, again, not supported in the guidance necessarily, but some sort of industry standard, if you will, that maybe they've gotten comfortable with. All
Yeah,
right.
documentation's key here. You want to make sure that you have a well documented file and you're really looking into all of the facts and that it really is physical work of a significant nature. One other thing that I want that just kind of came to my mind, Tony, we were talking about work off site and manufacturing specialized components. While you're documenting that file, it's also key to be mindful that it isn't just that you've entered into a contract with that supplier or manufacturer to make the specialized component, but that they are truly physically working on it, right? It isn't just that, well, I've entered into this contract and, I know that they're going to make that transformer for me. It can't just be that. They have to be physically working on it. And so, with that, you need access from the manufacturer to prove it out. Prove it out for your file. If you need an independent engineer to get in there and assess that what's being made here is special to your project, that's helpful. Get a tax attorney, like you said, to look at the facts, give you advice, write a tax opinion. These things are all crucial when you're building your fact pattern, especially for something that can be so subjective and not quantified.
Definitely. Some other ideas there to consider. Again, these aren't things that are necessarily backed up in the guidance, but these are just helpful things to think about as you're approaching a physical work offsite scenario. You've got you're hiring a vendor. Oftentimes when you hire a construction provider, construction installation companies, they'll invoice you on a monthly basis, let's say, and they invoice you pursuant to that AIA document. Okay. And that AIA invoice will tell you the total budgeted amount for that product. And then then they'll have another column on that invoice that says total completed and stored to date. And then another column that says, amount remaining to finish, right? And so I'll say to my clients, look, if you're going to pursue this physical work of a significant nature standard, consider getting your service provider or component supplier to send you an AIA style invoice document that shows the total completed and stored to date, and keep getting that on a monthly basis so that you can show that progression. Other ideas are, get photos, have the service provider send you photos of the progress that they're making on a periodic basis so you can see the evolution of whatever they're making for you evolve over time. Time reports, time sheets, all that kind of stuff. Again, these aren't things that are in the guidance, but they might help you build your file to document that things are moving along and that you're making progress. All right. My team doesn't provide any third-party deliverables to help clients document their physical work of a significant nature profile. I don't know if your team does. Do you provide any deliverables here? And if not, what kind of services? Is it consulting, or do you provide or do you actually provide a report?
Yeah, like you, Tony, my team doesn't provide any type of deliverable for the physical work test. It's really more on a consulting basis. We're talking about the facts, we're talking about the strategy, we're helping kind of pull together maybe the paper trail. And so that's what we're doing there. It's really on a consulting basis. There isn't then an end deliverable that we're providing related to this. That I would advise my clients, if you're pursuing that route, then you're spending a lot of time talking with your tax attorney, and you're asking what can they provide. They usually provide tax opinions or like a begun construction certificate, and because of the qualitative nature of this, it lends itself more to having a deliverable from a tax attorney. But we certainly are in there helping and talking with our clients about the strategies and the issues, and it's on more of a consulting basis.
Okay. So that provides maybe a little bit of a nice segue to our next topic, because although we don't provide deliverables to document physical work of a significant nature, we definitely provide deliverables to help document meeting the next approach under the begun construction criteria, which is the 5% test, right? And so if you're good with the physical work stuff, maybe we pivot and start talking about 5%.
Let's do it. Let's do
Great.
it.
All right. So I'm going to stay in my role as your new client. You've helped me really understand the physical work test. That's wonderful. Now I'm just thinking, all right, due to the subjectivity of that analysis, now I'm thinking maybe I want to pursue that. I get it. The physical work test might be more cash efficient for me. However, I don't love the subjective nature of that analysis. I think I want something that's easier for me to sort of prove out, show investors, show the IRS if need be. So maybe let's pivot now and talk about my options under the 5% test. So now I say, look, I come to you and I say, look, I've incurred costs. Now we're not talking about physical work, we're talking about costs. So I've incurred costs to obtain site control. I got a power purchase agreement or some other type of revenue generating contract. I've earned a fee. I've been providing really valuable development services to this project, Josh, and I've generated a fee I'm going to charge for myself for all the hard work that I've done. And so what are your thoughts on the types of costs I've incurred so far?
Okay. So we're talking about site control costs, power purchase agreement, and a developer fee. Basically talking about some soft costs here. I'm nervous, very nervous about this fact pattern. So Number one, the 5% test would be incurring 5% of energy property costs. While you listed a few things that potentially could be included in energy property, not all of those things are included in energy property, like power purchase agreement, revenue contracts. That's an intangible asset and not included in energy property. So we can't count that. Um, Developer fee, sure, at the end of the day, there might be some element of the developer fee that goes into energy property, that can become a little more subjective again. And so I would say that high level soft costs and indirect costs are challenging to utilize for this 5% test because there's some risk that's involved there. There's some risk as to, did you incur the cost? And is it going to be included in energy property? Some amount of that soft costs may not end up in depreciable basis or energy property at the end of the day. And so while there may be some path to include certain soft costs, it's not a home run. It comes with some risk, and so what you described there, by those three types of costs, I'm a little nervous. I want to find out more about what other costs we can incur here to meet that 5% test.
Okay. All right. I appreciate that. All right. So look, I want to make sure I meet the test, right? So if what you're telling me is what I've done so far isn't ideal, what do you recommend? What types of costs do you think help best kind of support a 5% fact pattern?
Yeah, right. Because this test is incredibly important, right? And so I want us to be risk adverse. I want to be thinking about costs that you're not going to have to worry about it being contested. And so for that, let's incur hard costs for the energy facility. I'm talking about modules, inverters, racking, maybe switch gears, battery storage if you have a battery component. If we're talking wind, the turbine blades. Let's incur costs that are hard physical, equipment style costs, when we're handling this 5% test.
Okay. All right. So that reminds me. All right. So now I'm going to pivot a little bit. I'm stepping away from my role as the developer for a moment. I'm coming back in as a service provider. So when I talk to clients about the 5% test and they're pitching me various types of costs that they've incurred and they want advice on what they should incur, I like to think of 5% eligible costs as being broken down into sort of four major categories. I think of it as like a hierarchy of cost categories. Category one being the strongest is the category that you just referred to, which are hard components procured from third parties. That's tier one cost for 5% purposes. Tier two would be hard components procured from related parties. Okay. Tier three, soft costs incurred via third parties. And then your last tier of cost, your weakest tier, if you will, I like to think of it as related party soft costs. Okay.
Sure.
And so, look, at the end of the day, there are costs from each one of those tiers that may wind up in your final eligible basis. But for this 5% test, in terms of the costs that you want to rely on to get your project through financing and ultimately maybe through an IRS audit, I just like you, I stress to my clients, you really want to focus as much as possible. You want to focus on those tier one costs, again, hard components procured from a third party, right?
Yeah,
Sounds like we're on
tier
the same
one,
page there.
maybe some tier two, tier one, tier two. That's where you want to be. These hard component costs, and your investors are going to feel the same way. We've been working on these 5% tests for a while, and clients will try to throw in some of these soft costs, and almost every time, you get pushback. You get pushback from an investor for the right reasons, under the scrutiny of an IRS audit. Those are challenging to support. And so, with how important this test is, it's always been important, but even more so now when we're talking about a potential cliff, for ITC eligibility, PTC eligibility, you certainly don't want to be living in the tier 4, tier 3 space. You're wanting to feel really good about your margins on the 5% test.
Totally. Yeah, and I get it, right? I mean, if you're a developer and at the end of the day, you couldn't get as much in the way of hard components from third parties, you might have to sort of rely on some of these tier 2s, 3s, and 4s. All I'm saying is, to the extent it's within your control, you really want to strive to get as much in the way of tier 1 costs as possible. All right.
And
So,
when you're
yeah,
doing it, a really important thing here is making sure you're focused on the denominator and what your estimated costs are, estimated energy property costs. Okay, different structures that you might implement from a financing standpoint might change the results. So a lot of projects use, fair market value step up sales. And so when we're talking about energy property in that instance, we're talking about that stepped up fair market value, right? Some projects are on a cost basis, the cost to build without any type of step up, and then that would be your denominator for your energy property. And so I would advise my clients when you're thinking about this, you better be super conservative with the denominator, right? You don't want to have misfired on what your estimated costs were, because what happens, it's not about the estimate of when you did the 5% test, now before the end of the year for a project that's placing in service, down the road. It's what is the 5% spend on the final energy property costs, right? And if you miss that and now you're only at 4% because there were overruns, there were, the fair market value was higher than I thought it was going to be. You failed the begun construction test for which you thought you had passed it. You were barely getting there. You were 5 and some bips, right? We better be trying to be conservative there. Maybe put some margin behind that number, get 6, 7%, and then your denominator better be contemplating all of these potential change orders and what have you. Be conservative, put some contingencies in that bottom line number.
yeah, right. Assume there could be some change orders, right? I mean, look, if some of these tax credits end up getting phased out sooner than we want, that's going to lead to a lot of pressure to get these projects built ASAP. Could keep component prices high. Could lead to projects kind of the construction costs going up. So I like your comments here about be conservative on the denominator, right? Assume it's going to go up. You could have change orders, valuation changes. Could be a number of different things there, and try to get. And then as far as the denominator goes, with that denominator, try to get there with hard components. Maybe you pad it, try to get over the 5% even with hard components. And
Mhm.
then at the end of the day, if you get some soft costs, maybe they help pad that even further, right? But be conservative on both sides. All right. So now drilling in a little bit deeper here on the 5% test. So uh, this next question, I'm going to focus on accrual basis taxpayers. All right. So this doesn't pertain to cash basis taxpayers. It's an accrual basis taxpayer scenario. And can you talk about, paying versus incur, and the quote unquote 3.5 month rule versus, getting title without necessarily paying anything? Can you break that down for us a little bit?
Sure. Yeah, this is very much a key issue when we're talking about the 5% test. It's paying or incurring the cost, right? And so when you're an accrual-based taxpayer, it's not just making a payment. It doesn't count here if we're talking about a deposit on a large equipment purchase order. You're really incurring the cost. You've entered into a binding written contract with the supplier manufacturer, and that you're actually incurring that. And so a key factor in that test to prove that you've incurred it would be that it's delivered to you. You take title within 3.5 months of that payment of when you've incurred the cost with the supplier. And so that's crucial. It's not just making the payment, but you've also got to be sure that you're getting title in time. And that can take on a lot of different meanings, but it's not necessarily that it's been delivered to you on site, that you're in physical possession, but that you have title of those assets. And that's where I would strongly advise talking with your expert advisors what that means with regard to your contracts. But yeah, it's not just paying. It's not just paying the 5% of the costs. It's incurring it.
Okay, great. And any words of wisdom or cautionary remarks on contractual terms there?
Yeah. And so the environment that we're going to be facing here is that there's going to be some supply constraints, right? Everybody's racing to incur these costs, and I think what's going to really happen is suppliers, manufacturers are going to be squeezed. They're going to make a lot of promises, right? They're going to hear from you how important it is that you need to buy these modules, that you need to buy these inverters, and they want to make the sale, right? They want to sell you their components, their products. When you're entering into these negotiations and entering into these contracts, I'm not an attorney, so you're going to want to talk to your attorney about this and have them they should be reviewing your contracts. But from my experience, what I would certainly advise here is that you're talking about this 3.5 month rule. You're talking about how you have to take title. It's not just that I'm paying you for these modules. I'm not putting a deposit down. You're incurring this cost. We're entering into this contract. And so, you want language in there that the supplier is committing to. Maybe they're guaranteeing delivery. They're guaranteeing you're going to have title within 105 days or 3.5 months. And they may even go so far as to say, I'll incur damages. I'm so confident I'm getting you these components that, you know what, I'm going to guarantee it and I'll incur some damages. You want some teeth behind it, right? You want some teeth in that contract that really evidences and proves that you're not putting a deposit down, you're incurring the cost with the supplier.
Great. And it's just underscore the excellent feedback. Love that. A couple things I just want to underscore there, as you said, we're not attorneys, all right? So we don't provide legal advice. We're accountants. But I love your points. What I like to say to clients here is don't try to get too cute with your contractual terms, right? Clients are calling me, they're trying to pitch different ideas on contractual terms to make them sort of different than what they normally enter into with their suppliers. I say it's not about that. You want terms and conditions here that look and feel as close to whatever you normally enter into with your suppliers as far as overall terms and conditions, right? This is supposed to be a third party arrangement. It's got to have all those classic third party terms and conditions. And it's kind of different here, as a lot of clients do pursue that pay now. You pay the money up front, you get title within 3.5 months. That's the one wrinkle that I think you find here is when clients are trying to do satisfy the 5% test under the 3.5 month rule. But aside from that, you really want your terms and conditions to look as similar as possible to the standard terms and conditions that you would normally execute under. And don't hem and haw too much. One thing that I find with clients with begin construction, they will hem and haw throughout this time period of they know that there's a sunset coming where they need to begin construction. And again, in sort of an effort to protect their downside risk, manage cash more efficiently, they try and over-engineer the contractual terms. As they're doing that, they're getting further and further away from standard third-party terms and conditions. And as they get further and further away from that, it gets harder for you to convince your attorneys that you've actually got a bona fide contract for this purpose. So be careful. Try to stick to standard terms and conditions as much as possible. And time is of the essence to start your construction. The longer you wait and try to over-engineer your terms, the tougher position you're putting yourself in because components are flying off the shelves, fewer suppliers to deal with. It's going to force you to pay even more for components at the 11th hour. So
Yeah.
I encourage people to just sort of like temper your desire to want to over-engineer terms and conditions. All right, Josh, what kind of services do we provide here for the 5% test?
Right. Yeah. So we provide what's called a 5% safe harbor AUP, agreed upon procedure engagement. And what happens there is it's a fact finding mission. We pull all the facts together and we document our findings. And the beauty of an agreed upon procedure engagement is it can be customized. It can be custom fit for the fact pattern, for the issues at hand. And so we can do a lot of things there that you and your investors want to see to prove out the facts. Notably, we might obtain purchase orders. We might obtain supply agreements. We would vouch to the payments made. As far as the 3.5 month rule, we might collect bill of lading information, prove that you've taken title. And then once we've gathered all the facts and the documents, we're performing math. We're gonna calculate if you've incurred all of these costs, what's then your estimated energy property? What evidence is that for you? And then that report would do the calculation, and so then you and your investors have this nice report that goes through all of that fact finding and evidences what you've done there to support your tax file.
Love it. Great. Yeah. And we usually do this in sort of two phases. We'll do one sort of in the earlier stages when you're first incurring the costs, right? We'll do that sort of as a preliminary 5% AUP. And then at the end of the day, when the facility is placed in service, oftentimes we're asked to come back and do a bring down of that based off of what the actual final denominator costs are. Novogradac has been doing 5% AUPs going back to pre-2010. I think we've probably got as much, if not more, experience in this area as any accounting firm. We know it well. Josh, I can tell that you know this stuff inside and out. And all right, so thank you very much. Listen, I want folks to stick around because in a minute we're going to do what's called an off mic section. But before we get to that, I just want everybody to know that I will share Josh's contact information in today's show notes so you can contact him directly with any questions that you have. I'll also include a link to today's show notes to the Novogradac Renewable Energy Tax Credit Finance series on YouTube. We have a dedicated YouTube playlist that you can access on demand. I'm sure this one will be a huge hit. And so, Josh, I want to thank you, but stick around because let's get into our off mic section.
Perfect.
Are you ready?
I'm ready.
All
Ready
right.
if you are.
Yes, I am. All right. So the off mic section, Mike Novogradac's been doing this since he started doing the podcast. But about a year and a half ago, I came up with an idea to add a twist to the off mic section. We used to do the off mic section where Mike would ask his guests to provide some sort of insight into leadership tips and tricks, work efficiency tips and tricks, maybe good business books you've read lately, other podcasts, all that kind of fun stuff. Then one day I said, look, let's spin it in a new direction. I want to go in the direction where we give shout outs, industry shout outs, and it can either be to somebody within the firm, outside the firm, an advisor, a client, you name it. All right. And so he went with it, and that's what we've been doing for a while now. So I want to ask you, Josh, who do you want to give an industry shout out to?
Yeah. So I love the industry shout out idea. Ever since that started gaining momentum, me, I'm a planner, and so I then put a list together. I was like, one of these days, I'm gonna give a shout out, and so I have my list. Like here are my industry shout outs, and so normally, I'd be thinking about my key clients that I work with on various subject matter, folks that I'm in the trenches with, and we're working on a lot of complex tax issues. But kind of going into the weekend, I had that list, right? I knew we were doing this podcast this week, and so I was ready. I had people in mind. But as things have evolved politically over the weekend, that's all I've been thinking about. I don't know about you, but I've been watching all the updates on what the Senate is talking about and what they're negotiating and what they're fighting for, and so I have to give my industry shout out here to Senator Tom Tillis. He's been an absolute champion for renewable energy, and the courage that he's shown in the discussions that they've been having on the Senate floor is inspiring. And so I definitely give him that shout out, and for how knowledgeable he is about our industry, that really impressed me. And so he's about the fight. He's about the fight for renewable energy, as a lot of us are, and there's a lot of folks lobbying with these key politicians on these matters. And so I want to give him a shout out for those efforts and what he's doing there for us.
Awesome shout out. Awesome shout out. Like you, this past weekend when my wife and kids were at the beach, I was at home kind of glued to the news, reading and listening. And then this, you sent me actually a really nice link. You sent me that YouTube Tillis link of him giving that
Yeah.
speech defending renewable energy on the Senate floor. I thought he did such a great job. And so I really appreciate his hard work on behalf of the industry. This is a critical time in this industry, not to mention the country's sort of energy in our, this is our sort of a cause to sort of meet the demands of the what the energy industry needs. So awesome shout out. I love it. All right. So Josh, thank you. Okay. And this was a fantastic podcast. And I know you've got a list of other shout outs. And so I hope you'll be back as a guest and to kind of give those shout outs. So thank you, Josh. And to our listeners, I'm Tony Grappone. Thank you for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.